So you did it. You got the loan approved. And let's be honest, that's a huge moment for any new commercial banker. It feels great. But once that ink is dry and the money's out the door, that's not the end of the line. Not even close. In fact, it's really just the beginning.
And that's probably the exact question running through your head. You've got this initial win, which is fantastic, but then this feeling of uncertainty can creep in. Okay, what happens now? What am I supposed to be doing for the entire life of this loan?
Because this is where your real work as a lender truly begins. Managing that loan successfully is a whole skill set in itself. You could even argue it's more critical than getting the yes in the first place. It's a total shift in thinking, from a one-and-done transaction to managing an ongoing relationship and all the risk that comes with it.
Which, of course, brings us to the scenario every banker hopes to avoid but absolutely has to be ready for. Look, no matter how amazing your credit assessment was, you just can't predict everything. The economy can turn on a dime, industries get disrupted, and businesses hit roadblocks nobody saw coming.
And when those repayments stop coming in, that's it. You're at a critical moment. All the theory you learned in training suddenly meets a messy, complicated, real-world problem. And your ability to figure out the best way to recover that loan, well, that can define your career.
So, when a loan gets into trouble, you're going to find yourself standing at a crossroads. It's a tough spot to be in for sure, but the good news is your options are actually pretty clear, even if the decision itself is hard.
When that borrower stops paying, you basically have three main paths you can choose to go down.
Okay, so let's walk through these. First up, you can just terminate the loan. This is the hardline approach. You call the loan due, and you start the process of cashing in on any security you hold. Option 2, you can wait it out. You give the borrower some breathing room, maybe a little flexibility, and you hope they can trade their way out of the trouble. And then there's option 3. You can actually lend them more money to try and help them fix the problem. As you can see, each one is a completely different strategy.
Now that third choice, lending more funds, it can be really tempting, right? But it's also the riskiest. It's what you'll hear seasoned bankers warn you about, calling it throwing good money after bad. It demands an incredible amount of careful thought because if there isn't a crystal clear path to recovery, you might just be making the hole deeper. So yeah, that's the million-dollar question, isn't it? You've got these three totally different options, each with its own set of risks, its own potential rewards. How in the world do you make the right call? Well, it isn't about gut feelings. It's about having a solid framework.
And this is that framework. Think of it as your playbook. It's a set of guiding principles that gives you a structured way to think through that crossroads, no matter which option you're leaning towards.
The very first principle is timeliness, and this one is huge. Hesitating can be absolutely fatal in these situations. You really only have a limited window to act before a problem becomes impossible to fix. Being decisive and acting fast can literally be the difference between a manageable issue and a major loss.
Next, communication. This is all about being upfront with everyone. No surprises for your customer. And just as important, no surprises for your own leadership. Your job is to manage expectations and keep information flowing, honestly and constantly. That's how you build trust, even when things are tense.
And all that communication, it has to be documented. I know, documentation can feel like a chore, but this isn't just about red tape. A well-kept file is a powerful strategic tool. It makes sure everyone at the bank is on the same page, looking at the same facts, so you can act as a unified team.
So, as you apply these principles, your strategy is going to fall into one of two big categories: a work along or a work out. A work along is just what it sounds like. You're working with the borrower to fix the business and improve their situation, all while protecting the bank's interests. A work out, on the other hand, means you're trying to get your money back and end the relationship, either by having them refinance somewhere else or by liquidating assets.
No matter which path you take, you are going to be negotiating. And the golden rule here is quid pro quo. It's a fancy Latin phrase that just means something for something. You trade, you don't just give things away. If you make a concession, say you give them more time, you have to get something valuable for the bank in return. Maybe it's an extra guarantee, maybe it's a higher interest rate.
And finally, leverage. Before you even sit down at the table, you have to be brutally honest with yourself about who has the upper hand here. Who's holding the cards? Does your borrower have other options? How solid is the collateral you're holding? Knowing that balance of power is what dictates your entire strategy and how much you can actually shape the final result.
You know,
When you put it all together, the timeliness, the communication, the negotiation, it all rests on one single foundation. Your greatest asset when you're managing a troubled loan isn't the contract or the collateral. It's the relationship you've built with that customer since day one.
And building that relationship, it's not a soft skill. It is a core part of mitigating risk. It's like preventative medicine. When you communicate clearly, when you show you're actually interested in their business, when you offer advice without being bossy and explain your decisions, you build a foundation of trust. And that trust is what lets you solve problems with them instead of against them.
So I'll just leave you with this final thought to chew on. When you're staring down one of these troubled loans, your mindset is everything. Are you just trying to stop the bleeding and avoid a loss on your books? Or do you see this as an opportunity? An opportunity to really prove your skill, to build trust when it's hardest, and maybe, just maybe, to turn a really bad situation into a relationship that lasts for your entire career. That choice, that perspective, is all yours.